The story of 2022 to 2025 is not just about AI. It's about the trade the world quietly accepted. 1 million jobs lost, hundreds of billions poured into data centers, and the belief that artificial intelligence will one day pay the bill. But today the cracks are showing. AI stocks are sliding, the market leaders are wobbling, and for the first time, the cost of this revolution has landed on human shoulders. In the past 3 years, tech companies announced massive job cuts across engineering, support, recruiting, operations, and entire teams built over a decade. Every year the list grew. Every month another wave came. It wasn't because companies were failing. It was because the business model changed. Instead of hiring people, they invested in compute. The story is simple. More servers, fewer workers. Public and private job cuts in the US have already surpassed 1 million this year. Only 4 other times in the past 30 years, 1 million plus jobs have been cut in a single year. 2001, during the dot-com crash, 2008, Great Recession, and 2020, when the COVID pandemic hit. And now, 2025 joins that list. While workers packed boxes, another part of corporate America was exploding. AI infrastructure spending. Billions for GPUs, billions for cloud build-outs, billions for power, cooling, land, fiber, and new data centers. Industry estimates now suggest that AI and data center spending by major tech firms will surpass $2.8 trillion by 2029, with about $490 billion projected for 2026 alone. This is the largest infrastructure expansion since the early internet. Except this time, the returns are not guaranteed. Here's the part almost no one talks about. AI is expensive, extremely expensive, but the revenue still early, still unproven. Training costs skyrocket, inference costs grow faster than adoption. Every new capability requires more compute, more power, more hardware. The economics don't match the enthusiasm, not yet. According to Citigroup, industry AI revenues are estimated to reach only $780 billion by 2030, up from roughly $43 billion today. That indicates a massive gap between what's being spent and what's being earned. To keep earnings shiny, some companies turn to classic tools, extending the lifespan of servers, lowering depreciation, boosting profits on paper without actually making a dollar more. It works for a quarter, maybe two, but it doesn't change reality. Behind the scenes, costs rise, margins compress, the narrative stretches further than the numbers. This isn't sustainable earnings growth, this is a presentation. Even the strongest companies, the so-called Magnificent Seven, spent the last 3 quarters quietly reshaping themselves. Teams trimmed, projects paused, hiring slowed, entire divisions reorganized around AI and efficiency. Because in a world where AI is the new electricity, every company believes the same thing. If we don't spend aggressively now, we lose later. It's FOMO, the fear of missing out. So they cut people for compute. But this shift has a cost, a human cost. For millions of workers, this wasn't innovation, it was displacement. Jobs eliminated not because people failed, but because AI became the budget priority. When a company must choose between salaries and silicon, it chooses what boosts future valuation. People are not inefficient, they're just not exponential. AI spending is. And now the cracks are visible. This week's market sell-off hit the AI leaders hardest. The same companies that lifted the entire market are now weighing it down. Investors are asking tough questions. Where are the profits? Where are the returns on these massive investments? How long can this spending continue before the bubble breaks? AI was supposed to be the engine of the next bull market, but an engine that burns cash instead of making it cannot run forever. Here's the bigger risk. The top of the S&P 500 is more concentrated today than at any point in modern history. A handful of companies lifted the entire index, but concentration works both ways. When they rise, markets fly. When they fall, the whole index shakes. If this slide continues, 2026 won't begin with a boom. it will begin with a reckoning. So here's the question. Is today just a dip? Or is it the beginning of a deeper shift? A shift where investors finally ask, how long can we fund AI dreams while cutting real jobs? How sustainable is an economy built on cost cutting and capex? What happens when the hype slows and the bills come due? The answers may define the next decade. This is MarketVelugu Light on Markets. If you found this insight useful, like, share, and subscribe. And let me know in the comments, is the AI boom transforming the world or just transforming balance sheets?